Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money games companies play with all these fancy reports, let's just say. This next report is going to give us a real good look at what happens when you try to juice up income with fixed income instruments. It might not be as exciting as a tech startup, but trust me, there are some very important lessons here about risk and return. Alright, so today we are dissecting a filing from Tidal Trust I, which is the parent company for a couple of investment funds, specifically the Sound Enhanced Fixed Income ETF and the Sound Equity Dividend Income ETF. This is basically a report card on how these funds have been doing over the past 6 months ending May 31, 2025. Let's dive into the Sound Enhanced Fixed Income ETF first. This fund aims to give you some steady income while also hoping its investments grow. They call it tailoring a shareholder report because they want to give you the juicy bits without all the legal jargon. First up, let's talk about what it costs to own a piece of this fund. If you invested $10,000, you would have paid about $24 for the last 6 months. That's about 0.49%, which isn't too bad actually. It means for every $100 you invested, they took about 49 cents for their services. The fund size as of May 31st, 2025 was a little over $40 million. That might sound like a lot, but in the investment world, it's 9 different investments, which means they are spreading their bets around. Now let's look at where they put that money. The biggest chunk is in financials at 0.536%, followed by exchange traded funds at 0.129%, and then consumer cyclical at 0.079%. It seems they are playing it relatively safe with a big focus on financial companies and other funds. Digging deeper into their investments, the top holdings give us a clearer picture of their strategy: Ares Capital Corp, Hercules Capital Inc., and iShares 0 to 5 year high yield. Corporate bond ETF are among their top picks. These are mostly companies that lend money or bonds that are a bit riskier but offer higher returns. Think of it like lending money to businesses that aren't quite big enough for traditional banks. Still pretty solid, but with a bit more risk attached. These top 10 make up a significant part of the fund. Now let's get into the nitty gritty of their actual investments in the Sound Enhanced Fixed Income ETF. They have a good chunk, nearly 28% in preferred stocks. These are like a mix between stocks and bonds. They usually pay a fixed dividend but don't give you voting rights like common stocks. Many of these are in banks like JP Morgan Chase and Bank of America, with dividend rates going from around 4.25% to 6%. They also have investments in companies like Associated Bank Corp and Truist Financial Corp. Then we have corporate bonds, which make up about 27.6% of the fund Harry's, where they are holding debt from everyday companies like Goodyear Tire and Rubber American Axle and Manufacturing and even Dell Inc. These are bonds that these companies issue to raise money. Think of it as lending money directly to these companies, hoping to get paid back with interest. Common stocks are about 19% of the fund, and here we see names like Ares Capital Corp, Blackstone Secured Lending Fund, and Golub Capital BDC. And as you can see, a lot of these are business development companies or BDCs. These are companies that invest in small to medium-sized businesses, often those that can't access traditional financing. It's a bit of a riskier but potentially higher reward investment. Real estate investment trusts, also known as REITs, make up 10% of the portfolio. These are companies that own, manage, or finance income-producing real estate like shopping malls, apartment buildings, or office complexes. Companies like Realty Income Corp and Simon Property Group are in this category. They also invest in other exchange-traded funds or ETFs, which are basically baskets of stocks or bonds. This adds another layer of diversification, but also means they are paying fees on fees for some of their holdings. Now let's switch gears to the Sound Equity Dividend Income ETF. This fund focuses on companies that pay out good dividends, which is like getting a regular income stream from owning their stock. For this fund, if you invested $10,000, it would cost you about $22 in the last 6 months. That's 0.45%, a little bit cheaper than the fixed income fund. This fund is a bit smaller with about $29.5 million in size, and it holds 35 investments of total net assets. So scroll here, the sector breakdown is quite different. Financials are still there, but it's lower at 0.195%. Consumer non-cyclical is a big chunk at 0.181%, followed by energy at 0.151%. This fund seems more diversified across different industries for income generation. In terms of top holdings, we see Enbridge Inc., Citigroup Inc., and Eversource Energy. Leading the pack, Enbridge is a major player in energy infrastructure pipelines. Eversource Energy is an electric utility company, and Citigroup is a big bank. All of these are known for paying dividends. Let's look at the actual investments in the Sound Equity Dividend Income ETF. This fund is heavily invested in common stocks, making up almost 99% of its holdings. Here we see energy companies like Enbridge Inc. and Valero Energy Corp utilities like Eversource Energy and AT&T Inc. Plus. A lot of big names in various sectors like Citigroup Inc., IBM, and Coca-Cola. These are all companies that pay dividends. They also have significant investments in packaging and containers with companies like Grafe Inc. and Semeco Products Co. Pharmaceuticals are another big area with GSK plc, Pfizer Inc. and Abivia Inc., which generally have stable cash flows and pay dividends. Pipelines are also a significant investment with Enbridge Inc. and OneOK Inc. These are often seen as stable income generators. Now let's look at the financial performance itself. The statements of operations show how much money the funds made and what they spent. For the Sound Enhanced Fixed Income ETF, they had investment income of about $1.4 million. This comes from dividends and interest on their bonds. However, their net realized and unrealized gain or loss was a negative $1.9 million. So while they earned income from their investments, the value of those investments went down during this period. This means the overall increase in net assets from operations was a negative $629,000. The Sound Equity Dividend Income ETF, on the other hand, had total investment income of around $727,000. But they had a net realized and unrealized loss of nearly $3.1 million. This resulted in a negative increase in net assets from operations of about $2.4 million. The statements of changes in net assets showed how the total value of the funds changed over time. With the Sound Enhanced Fixed Income ETF, their net assets decreased by about $1.8 million during this 6-month period. This was after they paid out distributions to shareholders, which is like them giving back some of the income and gains they made to the investors. The Sound Equity Dividend Income ETF saw its net assets decrease by a larger amount, about $1.9 million. Again, this is after paying out distributions to shareholders. These financial highlights give us a per share look at the performance for the Sound Enhanced Fixed Income ETF. The net asset value per share at the end of the period was $17.86. They had a total return of negative 1.50% for this 6-month period, which is understandable given the market conditions. We also see that their expenses are about 0.49% of their average net assets, which aligns with what we saw earlier. The Sound Equity Dividend Income ETF ended with a net asset value per share of $24.59. Their total return was a negative 7.53% for the 6-month period. This fund seems to have been hit harder in terms of value decline. However, their expenses are quite low at 0.45% of average net assets. Now we get to the notes to the financial statements, which explain all the nitty-gritty details and risks. First off, the report details how these funds operate. They are part of Tidal Trust I, and their main goal is to provide income and potential capital appreciation. The Sound Enhanced Fixed Income ETF aims for current income with capital appreciation potential, while the Sound Equity Dividend Income ETF wants a dividend yield at least double that of the S&P 500. Under significant accounting policies, we learn how they value their investments. Equity securities are valued at the last quoted price. Preferred stocks and corporate bonds often get their value from independent pricing agents, which consider factors like interest rates and credit ratings. It's a bit of an art and science to figure out the exact worth of these investments, especially when the market is shaky. This section is super important because it outlines all the potential dangers of investing in these funds. For the Enhanced Fixed Income ETF, there are risks tied to business development companies, or BDCs, since they often invest in riskier debt, which means less public information and difficulty in valuing them. Credit risk is also a big one, meaning there's a chance issuers might not pay back their debts. We also see equity market risk, which is the general risk that stocks can drop in value, and exchange traded fund risks, which can include trading at prices different from their actual worth. Here we find out about the companies managing these funds. Tidal Investments LLC is the investment advisor, and they get a fee based on the fund's assets. The rate for the enhanced fixed income ETF is 0.49%, and for the dividend income ETF, it's 0.45%. The advisor then pays most of the operating expenses, including the sub-advisor who actually manages the investments. This fee structure is quite common. A really interesting part is note 9 about securities lending. The Sound Enhanced Fixed Income ETF allows the loaning of its securities to brokers to earn extra income. This is like lending out your stock to someone else for a fee. In this period, they loaned out over $11 million worth of securities, which was about 28.3% of their net assets. The money they made from this is disclosed in their statement of operations. The Sound Equity Dividend Income ETF did not lend securities during this period. Okay, so what's the big picture here? Well, these funds are trying to give you income, and they are doing it through a mix of debt and equity. But the current market environment means that the value of these assets has taken a hit. The Enhanced Fixed Income ETF is more focused on debt and BDCs, which are generally considered riskier but offer higher yields right now. The Dividend Income ETF focuses on dividend-paying stocks, which can be more stable but also saw a bigger drop in value this past 6 months. Overall, these funds are navigating a challenging market. The fact that their investments are down in value, especially for the Dividend Income ETF, is a key takeaway. The fixed income fund strategy with BDCs and higher yield bonds exposes it to more credit risk, while the dividend fund's dip suggests broader market concerns affected even stable dividend payers. What do you all think about these investment strategies and the current market performance? Do these funds look like a reliable way to get income, or are the risks too high? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate finance. And if you want to join a community of people who love dissecting financial documents, check out our Discord server linked in the description below. Thanks for watching, and we'll see you next time.